Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. As we stick with the markets, let's stay with the US. David Kelly of JPMorgan writing many investors should likely consider diversifying their portfolios by adding alternative assets and international equities. David joins us now for more. David, welcome to the program, sir. Let's get to that statement. Give us the why. Why?
Because we've got a tortoise of an economy and a hare of a market. I mean, if you look at sentiment, it's practically submarine sentiment. People feel absolutely miserable about this economy, and I think that's overstated. But if you look at the economy itself, we're slowing down to a crawl in the fourth quarter. We're going to pick up a bit next year, but I think it's going to be less than 2% real GDP growth. But meanwhile, we've got this extraordinary stock market. We've got very high corporate margins, and on top of that, we've got price-earnings ratios which are close to the dot-com bubble peaks. And when I look at that, it is out of whack. And so people should do everything they can to diversify their portfolios. They've drifted into being very overweight large-cap U.S. equities. And so I think they need to row against the tide and add other assets which are just not that expensive.
David, that's a struggle because the names we're talking about abandoning, NVIDIA, Microsoft, Amazon, Meta, Alphabet, these have delivered fantastic gains. AMD, Broadcom, on any given day up 10-15%. David, do you really want to give that up?
Well, there are two things. First of all, you got to be tax smart about this. So you should use new cash, stuff that you don't have to pay capital gains tax on, to try and rebalance the portfolio. But second, if you go back to the dot-com bubble, and there are growing echoes of that in what we're seeing here. Every company was not a winner. There were some great companies which exist today and which are leaders today, which were leaders back then. But there are many other companies, more companies, who disappeared then. So I think people just have to be very careful about valuations, company by company here. And it's I just think that everybody is essentially overweight the most expensive part of global capital markets right now.
So where do you suggest they should be looking?
Well, the first thing is U.S. investors are chronically underweight the rest of the world. And one of the things we've seen so far this year is the dollar's been coming down. And we know that the Fed is very likely to cut at the end of this month and probably cut again and just keep cutting, even though the economy is moving forward. Now, the European Central Bank is not going to be that dovish. I don't think the Bank of England is going to be that dovish. The Bank of Japan is going to be raising rates. So all that tends to push the dollar down. So we think the dollar will fall. And what we've seen in the past, and we show this in our guide to the markets, if you have a long period of dollar weakness, you also get a long period of international equity outperformance. And so I think that's the first place I would go is, why do I only have 5% or 10% or 0% of my equity money in international? That's the first place I'd go. And then the second thing is just alternatives. Alternatives in general have not rallied as much as these sparkly, champagne-filled public markets in the last 3 years. And that does leave some opportunities there.
David, though, when you think about international, do you have any pause or concern in terms of what we're seeing in terms of the rhetoric out of Washington and potentially companies and countries that can get caught up in this trade war between China and the United States?
Well, yeah, I think you've got to look company by company, but ultimately the rest of the world collectively is economically stronger than the United States is. So if you pick a fight with every kid in the playground, you may have a problem here. I think what's happening is a lot of countries are trying to find ways of operating outside of the U.S. sphere of influence. So I think what you'll see is over time, other countries, first of all, they're doing more fiscal spending in places like Europe. I think in China, they are very aggressively building up their technology base so they don't have to rely as much on U.S. technology. So I'd want to have a bet outside the U.S. I realize that what the U.S. is doing is not helping them, but it's not helping us either.
Well, David, let's talk about Europe. So European banks are up by 58% so far this year, and the ECB is projecting growth for 2026 of 1%. Now, if the U.S. economy is a tortoise and the market is the hare, what on earth kind of an animal is Europe right now, with the economy basically stagnant and the equity market ripping?
Well, Europe is a bit of a tortoise, but remember, you've got virtually no population growth in Europe, so on a per capita basis, it's not quite that bad. But these companies, the banking industry in Europe has been very cheap for a long time. So I think the rally that we're seeing in European financials makes sense. But I think you also just go company by company, and also recognize that the euro is, I think, very undervalued. And if the euro goes up in value, and every time the euro goes up 5%, your European stocks are going to go up 5%. So it's a lot of the gains we've seen in European equities so far this year have been because of a rising euro. And we think that trend has got a long way to play out.
The pushback I think we're getting around Europe at the moment, David, and I'd love your input on this, is when it comes to the major theme of the moment supporting both the economy and the market, which is AI, that Europe's in no man's land, that they barely have any competitors on the tech front, and when it comes to the energy needed to supply it, they're trapped by the left and the green lobby and can't do anything in response. David, what can they do to break out of that, and do you see any sign of that happening?
Well, yeah, they're not leading this charge right now. I think that's true. It still doesn't mean you should avoid individual European companies. And remember that, in the US, there's tremendous investment going on in AI. There's not quite as much cash flow coming in from genuine users at the end, and people are getting real value out of AI. So it's quite possible the capital spending cart will get ahead of the sort of income horse in AI in the US anyway. And also, we have to sort of look at this over time. Is AI really going to be a technology that you can sort of fence in the way that, for example, Apple was able to fence in hardware, and make money out of hardware forever, or Microsoft or Meta. So it's not clear in AI space who the ultimate winners are going to be. Is this a technology that really there will be one winner today? It's going to be the same winner 10 years out, or will it mutate over time? And will that give an opportunity to companies who aren't necessarily leading the charge here, but are able to catch up?
Stay with us. More Bloomberg surveillance coming up after this. Let's stick with the Federal Reserve. Tiffany Wilding of PIMCO writing the following. Chairman Powell's comments were consistent with our expectations that the Fed will cut rates again at the October FOMC meeting. Tiffany joins us now for more. Tiffany, good morning. So that's October. How much visibility do you have beyond October?
Yeah, well, I definitely think there's going to be more discussion around the December meeting. It does seem like October at this point is another cut. And I think part of it will be looking at the data that the government has not been able to issue since the government closure. And I think the concern actually is that the longer the government stays shut within October, there's not an obvious catalyst for it to reopen, like there has been in the past to date, that you could have major issues around collections in October as the BLS field workers literally just can't collect the surveys. So you could have an October where it's not about a delay in the data, but a skip. And, and that's going to be, a difficult situation for the Fed come the December meeting. And I think it's going to make, their job even harder.
Tiffany, but how uncomfortable is it going to be for the Fed to cut with potentially not having the latest labor market report, but having a CPI report that estimates are showing a hot print?
Yeah, so I think that they'll obviously look at a wide range of data. We have gotten other private indicators of labor markets, the ADP data in particular, which has been very consistent, I think, with the signals that we've gotten from the BLS data, that labor market activity has slowed quite dramatically. And as Mike McKee discussed, there's definitely supply and demand factors that are slowing that. We've seen immigration policies that have reduced labor force, potentially even reduced labor force supply, certainly slowed the growth of it. But on top of that, though, you've also had these trade policies, tariff policies that are increasing costs across industries, making it a very challenging environment for some industries to work in, and that is resulting in a reduction in labor demand as well. So at the current point, we've seen a reduction in both. Of course, the Federal Reserve is worried about the downside risks to employment, and so I think that's the consideration going into October. Certainly we will continue to see some inflation reports that are above the central bank's target as you get additional price adjustments. But it does look like that's relatively contained. That is, and that will wear off eventually.
The impact of tariffs, will that become a bigger story in December, given a lot of companies, even during this earnings seasons, were talking about the fact that they were able to bear the brunt of it, but at some point they're going to have to pass on the cost to consumers?
Yeah, I mean, and I do think that, as the thing about uncertainty is, and we've had elevated policy uncertainty, is that you don't really want to make any adjustment to your business because you don't know, you don't know the sort of rules of the game, if you will. You don't know what the policies will be. But as companies become more certain that the tariff policies are here to stay, then that means they need to make the adjustments that that they maybe have been holding off on to kind of see how this shakes out. And I think companies have, various ways that they can react to this. And within industries, there'll be competitive forces that they'll have to deal with. And, that's been one reason that we think that, the price adjustment piece of this might not be, where the full adjustment lies. And it does look like, when we look across a range of data, that the labor markets and companies, trying to manage costs and labor costs in particular is also being part of the adjustment here as well. So if you have larger companies that can hold down prices, they can afford to do so, then that's a really tough operating environment for everyone else. They're going to have to cut costs. They're going to have to cut labor in order to, to continue to manage in that environment.
Given some of the forces you described, Tiffany, do rate cuts help?
So, the Federal Reserve would still characterize their policy as being restrictive, in restrictive territory. And I think when you look at investment trends, excluding AI, they are quite stagnant, maybe even contractionary. That's both business investment ex AI as well as residential investment. Just looking at that alone would suggest to you that interest rates, are in restrictive territory. So I think the Federal Reserve would say, just given the balance of risks, moving back to a more normal stance, more neutral stance, at least, is a very reasonable policy. And that's what we think they're doing.
Of course, there's some debate about what neutral is, Tiffany, and it's a wide range of estimates. Where are you, and where do you think the Fed ultimately is?
Yeah, I mean, we think, we've sort of argued that on a real basis, kind of a 0 to 1%, these things are very uncertain, as you suggest, is 0 to 1%. So that kind of suggests, 2 to 3% real neutral interest rate. We think that could be higher within the band. There are various factors that have contributed to, a potentially higher, slightly higher neutral rate within that band over the last, number of years. But ultimately, that's going to be something that the Federal Reserve has to figure out. And, as they adjust policy slowly, they will get indications from the economy. And as they're cutting interest rates, if they see the economy is, reaccelerating and inflation is stickier than they expected, then, they can stop, they can continue, they can pause, see what happens, and they'll kind of get more, they'll sort of feel their way to neutral, if you will, and get more information. One other thing just to note as well is that fiscal policy in the U.S., we will get, more of the benefits from the offsetting tax cuts in the One Big Beautiful Bill Act in 2026. So that's something else that the Federal Reserve is going to have to navigate that could be tricky as well.
Stay with us. More Bloomberg surveillance coming up after this. Gil Luria at DA Davidson joins us now for more. Gil, welcome to the programme, sir. NVIDIA centre stage in the last 5 minutes. Big upgrade from HSBC. Big price target too. Street high, 320. Gil, when you think about things regarding NVIDIA, is it still the only game in town, or does AMD provide a bit of an alternative?
NVIDIA is not the only game in town, but will continue to be the main game in town. All of its customers are trying to diversify. They've been trying to diversify, but it's hard because NVIDIA continues to introduce products at such a fast pace that it's very hard for other products to even be comparable, which is to say, Google especially, and to some extent Amazon, are going to increasingly use their chips more. That's Broadcom. And then all of these customers, Microsoft, Amazon, Google, Meta, XAI, are going to have some AMD componentry just because they want to have diversification. But unless the AMD chips catch up in performance next year to NVIDIA's chips, that is going to be a small proportion. One way or another, even if AMD's chips are great, and Broadcom continues to generate a lot of good ASIC chips, the custom chips for these customers, NVIDIA will continue to have overwhelming share of this market for a while longer.
These companies continue to chug along, stock prices higher. We're seeing upgrades like this morning of HSBC at the same time where the rhetoric between China and the United States is really heating up. How are they going to get potentially caught in the crosshairs between Washington and Beijing?
They already have. NVIDIA, in fact, has missed its last 2 quarterly reports because of China. China is somewhat out of the numbers. It's not completely out of the numbers, but it's somewhat out of the numbers. And unless the US and China can arrive at some sort of broader framework for an agreement, NVIDIA's sales into China are going to be very much impacted for a while longer, and as long as that's happening. They have been all year, and it's been a drag on NVIDIA already. Having said that, the market is growing so fast right now that NVIDIA can probably live up to expectations without significant contribution from China. If China does come back, which it may not, NVIDIA can do even better. But the demand right now is so big that NVIDIA can probably do okay even if the demand from China is limited.
Who can't do as well as NVIDIA if the demand from China is limited?
It would impact NVIDIA more than any other company, but also AMD and Broadcom and much of the rest of the ecosystem that sells into China will be impacted. And long term, whether or not there's a full decoupling from China, we're already well on our way to having a much different supply chain than we had even a couple of years ago. You were just having a conversation about the fact that we're going to have to build a lot more of the supply chain in the United States. It's going to be a long process. It's very complicated. It goes well beyond Intel and TSMC. It goes through their whole supply chain that we will be gradually moving into the US and into other countries that are not China and not Taiwan in order to make the supply chain more robust. It's a matter of national security. And one way or another, we're having some level of decoupling from China. Whether both sides agree to that or not, companies are already understanding that there's never going to be stability in this relationship, so they need to diversify.
Stay with us. More Bloomberg surveillance coming up after this. Stocks finding a firmer footing as big bank results roll in. Steve Auth of Federated writing the following: it is possible that many companies will fail to beat whisper numbers of bigger than expected beats. This could cause some modest pullbacks for the stock market and for the market generally. Stephen joins us now for more. Steve, good to see you, sir. Good morning.
Good morning.
Thanks for being here. You said earlier this year, tie yourself to the mast, close your eyes, shut out the noise, and just keep moving forward with the ship because it's going to be okay.
Yeah.
Is that still the approach?
Yeah, we actually just set at this time of the year, we always set our 2-year target. We have a 1-year target also, but I'd like our clients to think forward a little bit further. That's kind of our horizon. We've got a 2-year target on the S&P of 8,600. And we don't think it's unrealistic to get there. You have a GDP that's reaccelerating next year. You've got multiple drivers of that we've talked about extensively. You have an AI industrial revolution going on that we think is very, very real. And importantly, and this is a key element of our forecast, is we have margins expanding on the S&P. And, most people at this time of year tell us that we're at peak margins. How many times have we heard that? So I had my guys go back and check this. We have relentlessly expanded margins on the S&P. Okay, 1 or 2 years you might dip a little bit, but the trend has been higher every year. And we think that's a combination of the mix of the S&P shifting towards higher margin, higher cash flow, lower asset businesses that just have higher margins, and productivity enhancements, which are increasing partly due to policy and partly due to AI. So when you add that all together, it's pretty realistic, frankly, to see earnings on the S&P by 28, which is where we'll be looking at in 27, getting close to $400 a share.
Talk to me about the multiple. When you describe the mix shift, what kind of multiple does that mix shift warrant?
So this is another heuristic that we've been talking about on this show for a while now, but that really, I think, fails people. The heuristic is, a fair multiple for stocks is 18 times. And in a 3% inflation environment, that's roughly been the case over a long period of time. But that's when the S&P was largely an industrial and financial index. If you adjust for the mix shift of the S&P over the last 5 years, where it's now largely a tech index, these are businesses with high cash flow, high return on investment. They're clearly, mathematically, worth a higher multiple of earnings. And when you adjust for that dynamic, we think the right multiple on the S&P is about 22 times. So we would say it's fairly to cheaply valued right here. So we're using 18 for the everything else, and we're using 25 to 28 for the Mag 7, if you will. And we get to a fair multiple of 22. So I think those two things are what make us more optimistic. And I think they're actually quite realistic.
I just want to say this up front, that the following statement are not my words. It's John Stolfus of Oppenheimer. He said the boomer mentality was holding people back and keeping them out of the market because of what you just said. Is that what you're confronting on a daily basis with investors?
Yeah, I mean, so many investors, this is one reason why we've been talking about a secular bull market. By a secular bull, I mean a market that does 10x over 20 to 30 years. You get only one a generation. I mean, we've only had two up to now. We're in the third one. I'm counting the move from off the Great Depression lows. We had a 20-year run, then the move off the 73, 74 crisis, which ended in 99. And then in 2013, once we broke through the old highs, we started this new secular bull. And one thing you always need to have is you need some sort of an industrial revolution happening. We've got that. And two, you need to have people have nearly lost their shirt in a historic way as the base, because that creates the wall of worry that's very hard. And you mentioned it, the boomers. A lot of boomers got almost wiped out in 07, 08. It was scary.
They're conditioned by that.
Yeah. And then you have, that's why you have these corrections along the way that just reinforce that fear. I mean, look what happened in late March, early April. Even Wall Street was running for the exits. And a lot of people raised cash. And now we've got this wall of cash. Everyone is very anxious to get back in. They've realized they're wrong, but they don't really want to say it. And that's why the corrections, I think. I mean, we've had a 30% move here without a 5% correction. That's like almost unprecedented over 6 months. So, we're feeling that there probably should be some kind of a pullback. My guess is it'll be lighter than you think because so many people are anxious to get back in. And we put out a piece this week that listed 6 ways you could get a pullback and, thinking through each of them. And, some are obvious, like, the Fed shutdown goes longer than thought, but a lot of them are self-correcting. I mean, if the government shutdown goes much longer, the pain on either side is going to be so high that they're going to have to come back to the table. The ones that I think could be more serious are China. I think, frankly, the comeback this morning on cooking oil was actually an attempt to de-escalate, because cooking oil is not really important to China. So, in a way, they kind of pulled a thing there that's like saying, hey, by the way, we do have other things too, but let's try to de-escalate this talk. But I think Xi's use of his one real ace, which is rare earths, I think that was a mistake on his part. I think even the Europeans are thinking, well, we have to figure out another way. We got to detach ourselves from these guys, and it's going to take time. So we'll have some sort of interim deal at least, but we're probably on a program to get out of that. We can't have China controlling the rare earth production. So if
this is your case about the potential choke points to the one big beautiful world in your piece, and trade you think potentially is going to offer the biggest headache, from now until when these two individuals meet, is that going to be an opportunity for a catalyst for these people that are sitting on cash to get back into the market? Well,
we're seeing that, right, Anne-Marie? I mean, we had a pullback on Friday, again on Tuesday, and money just keeps coming back in. So we'll see. I think if they come away at the end of this month with a kind of divorce, which I think is highly unlikely, but if they do, then we could have a more serious correction.
If you're so nervous about China's hold on rare earths and they're dictating what they're going to basically be able to export to the rest of the world, do you think the U.S. is having the right approach by having equity stakes in companies that are important for national security?
Yeah. Yeah,
You don't think it distorts capitalism?
Well, I'll distort capitalism in this case because we need to have rare earths, right? And what Trump understands is the Chinese were subsidizing rare earth production, and they drove the U.S. and European rare earth producers out of the market, basically. They underpriced the market and drove them out of business. So it's such an important element of almost everything in the economy, including our military. I think it's the right call here to say, look, whatever is the Chinese are going to do, we're going to support production of this key element of what it takes to, because otherwise you're in a real vice grip.
If free markets and open trade only works if everyone embraces free markets and open trade. And China over the last few decades did not do that, which is why you've seen the Republicans shift in the last 5-10 years. They're willing to sacrifice elements of capitalism at the altar of national security. Yeah. I think President Trump has led the way on that.
And Steve is exactly right. The big issue, of course, is what it means for the supply chain to the U.S. Defense Department. Almost every single weapon has these rare earths in them, and that is why it is a challenge when China has 90% of the market.
And there's a few contradictions that kind of make me laugh, but one of them is the auto market over in China. People will say that tariffs don't work. They'll be the same people that celebrate the auto market over in China.
Yeah.
Just try and sell a BMW 20 years ago into China.
Impossible.
They were all pushed to go in there and produce there, and everyone's celebrating the auto market in China. That's quite a contradiction, isn't it?
Yeah, and what we're thinking and looking at here, Jonathan, is we're thinking that post the settlement of this, let's call it the near-term plan for these economies to detach, which will take 3 to 5 years, which companies have major exposures to China, and how is that going to play out? And I think it's not a surprise that you see Apple today making a big investment in China, because they're one of the companies in the S&P, big ones, that have major China exposure, Tesla being another one as an example. So they're going to have to play both worlds. Apple's China investments, I can assure you, are not to export from China. They're to keep a Chinese market. They need it for their revenue base. So, and that's possibly a viable option, but this is going to be one of the things they're going to have to sort out here is who really depends on China, because that's going to be, I think that market is going to be kind of increasingly separated from the rest of the world. I think it's partly I think even the Europeans kind of woke up over the weekend when she pulled this.
Yep.
Took long enough.
This ace, that he thought, well, let me play this card. See, and Trump's known he's had that card. That's why he's after Greenland. So, he didn't need to do that to make. But I think it was a mistake. I don't know. I'm not at the table.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.